if any of you are regular viewers of the recordings that are made at these events, I apologise if you've seen this presentation, which I gave in Edinburgh 3 weeks ago. It won't surprise you, it hasn't changed much. But if you haven't seen it, welcome. I'm Richard Shepherd-Cross. I'm the investment manager to Custodian Property Income REIT. And as the name suggests, we invest in real estate. So a slightly different direction to the excellent presentation we've just had. And we try to be the real estate investment trust of choice for private and institutional investors seeking high and stable dividends from well-diversified UK real estate. So within that, what we've picked up, we're all about income, we're diversified, and we invest in the UK. And interesting to hear the comments about the change in focus away from the US and investors seeing real value in the UK. Well, I'm a big proponent of value in the UK, but let's just consider that investment landscape. It has been, particularly for real estate, really challenging since 2022 when interest rates rose so dramatically, because real estate and interest rates are very closely correlated. You know, what have we had over the last few years? It's all been about the Mag 7, it's been about geopolitical noise, people are talking macro all the time. But actually, you know, is it not the case that UK real estate with contractual income is a good place to hide out from all that geopolitical noise? I think it is. And I think that all that noise is drowning out the very real opportunity there is in UK real estate. We saw valuations turn in summer of last year. So 12 months ago, we started to see the end of the decline in property valuations following those increases in interest rates. And we have recorded quarterly valuation increases every quarter since then. But I think that the market is poised for a recovery. And when you consider the various factors, and I've split them up here into the challenges in the light blue, so geopolitical, you know, it is talked about a lot. And perhaps if we switched off 24-hour rolling news, we might actually be able to see that the risks that genuinely face us, rather than those that we perceive face us, because they are played relentlessly on 24-hour rolling news. UK politics, you know, that has been a challenge. We didn't quite get the growth budget I think we had all hoped for. Maybe a forlorn hope, but I think we hope for it nonetheless in November. It doesn't seem to be getting very much easier with UK politics. But perhaps two of the issues that have been more stubborn challenges, because over time you get used to the government you've got, and I think we all will come to terms with that. And let's face it, the last lot weren't very much better for real estate. It's been pretty difficult, whichever colour were in office. But the two challenges that have been greater is the doggedly high 10-year gilt rate. And I've talked about correlation, and we'll look at a chart in a moment, but UK listed real estate is almost perfectly correlated, inversely correlated with the 10-year gilt rate. And it was, you know, and it peaked, at least I hope it peaked, at the start of the year at near 5%, and it's come down to 4.5%, and there it sits. It's not really shifting, even though we're seeing short-term rates falling. And I know they didn't fall last week, but there does seem still to be a consensus that we will continue to see those short-term rates falling. And while the short-term rates falling is good for real estate, it gives us a little bit of additional earnings headroom. It's the 10-year gilt that really sets the investment yields, and they, I think, are probably not going to move in very much more. And the other challenge we've had is an imbalance between the supply and demand. As with all markets, you need supply and demand to be in balance, to keep markets in balance. And in the listed sector, there has been a distinct lack of demand from institutional investors. And they don't make up the whole market, but they are an important component of that total demand side of the equation. And While it's mixing, it's mixing the stats a little bit, I'm sure there is a direct read across from this statistic, and that is that in the first quarter of this year, UK institutional investment into direct real estate was at a 16-year low. So they're not really in the market. We need them to come back into the market to see some of the ratings improve, because as things stand, the UK listed property sector is at an average 23-24% discount to net asset value. And that feels too wide. Why do I think that's too wide? Because, as I've said, property valuations have recovered and they are rising. The really big story is rental growth. So while the investment market has been muted over the first months of this year, the occupational property market, tenant demand, has been really strong, and that's delivering rental growth. There's been a lot of corporate activity in the listed sector, and the interesting thing about the corporate activity is that those that are either taking real estate investment trusts private, typically US private equity, or those that are engaging in mergers and acquisitions, are typically pricing listed property at somewhere between net asset value and a 10% discount to net asset value. Yet the market as a whole is sitting at a 23 to 25% discount to net asset value. So those that are investing and can see the opportunity are pricing listed real estate much more keenly than the market as a whole. So I think that is positive. One of the benefits of the very wide discount for investors is that dividend yields are incredibly generous at the moment. Those wide discounts to net asset value mean that it's perfectly possible to get 6-7% dividend yields from listed UK real estate. And here you can see the correlation between the 10-year gilt and the FTSE EPRA UK REIT index, which is effectively the listed property universe. And I can tell you over a glass of wine what all the letters stand for. You know what half of them are. And you can see that very close correlation. But like I said, I don't think we're going to see those 10-year gilts come in very much. And earlier in the year, and this was a forecast from January and February, the forecast was that we might see 10-year gilts down to 4%. But actually, even if we don't, so even if investment yields stay where they are, with rental growth, you will still see capital value growth. And we've talked about the short-term rates. This chart is from the Investment Property Forum's consensus forecast. Who are the Investment Property Forum? They're the great and the good of UK real estate. So from banks to institutional investors to agents, real estate investment trusts, and they contribute to a consensus forecast of what returns are likely to be from UK real estate. This is the all property figures, and you can see over the next 3 years, north of 8% per annum, with income making up that very consistent and reliable 5% per annum, the larger part of that total return. So if you're going to get around an 8% return from direct real estate, and you can buy into real estate investment trusts that are trading at a discount, and that discount narrows, then a double-digit total return, is completely realistic. So if we look at Custodian, today is a quarter day, big day in a real estate investment trust life, because we collect rent from our tenants on a quarter day. And if we look back over the last 12 months, share price total return has been 17%. Yet we are still trading at a 16% discount, and you can still buy our shares and see a day one dividend yield of 7.4%. So that double-digit potential total return still feels very realistic. The window of opportunity to get into the market at close to the bottom is still there. So a little bit more about us in detail. And I've been doing this for about 12 years, and clearly I know why, at least I think I know why you should invest in Custodian Property Income REIT, But being a modern sort of a fellow, I decided I would ask ChatGPT, and this is what it told me. And on the right-hand side of the wheel, you can see it's picked up very obviously that we're a diversified portfolio. Very kindly said it was professionally managed. I'll thank AI for that. It's liquid because we're a real estate investment trust, so traded on the main market. And a real estate investment trust is tax efficient. We don't pay any tax in the corporate vehicle, so dividends are paid out of gross income. But it's really the left-hand side of the wheel that's the important bit. That stable income stream, the attractive yield, and a hedge against inflation. This has often been claimed by real estate that it's a hedge against inflation. What's interesting is that following the first real inflation we've had for quite some time, real estate is reacting with strong rental growth. That strong rental growth is delivering capital growth, so both the increased income and the increased capital value will protect the value of your pound. So I think that it all comes back to income, and that's what we focus on. What we're trying to do is to provide access to a portfolio that is quite different to many of our peers in that we have in 600 million of gross assets, 151 properties. It's actually 170 now because we acquired a portfolio, a little bit more about that in a second, just 2 weeks ago. And over 300 tenancies. So broadly diversified, typically with smaller than institutional investors would typically look at properties. And that supports a fully covered dividend of 6 pence per share. And with a passing rent from the portfolio of 44 million and an estimated rental value, ERV, of 50 million, you can see there's a strong reversionary potential, that rental growth that we were talking about. And if we look just in the last quarter at some of the metrics from the portfolio, they are all positive. And this is why I'm optimistic for the pendulum to swing. So through that last quarter, we saw 17 new lettings, 3 more post-period end, and you can see the sort of increases that are being delivered. New 10-year leases, 33% up on the previous rent. And even in the office market, a market that many people have written off, there is a building on Fountain Street in this very city, if you know it. And it's a building we refurbished. The rents were £20 a square foot. We've just let the 5th floor in that building at £36 a square foot, so an 80% increase in rent. So positive news on the letting side. And of the rental growth that we've delivered through the whole year, we've, I think, settled 15 rent reviews in the year to March at an average 29% increase in rent. So you can really see that rental growth coming through. And we're even delivering additional income from solar PV arrays that we've been installing on our industrial buildings, and just from 10 sites, and we think there's potential to put it on 90 sites across the portfolio as a whole. Just from those 10 that have been up and running for over a year, we delivered £100,000 worth of income in the quarter. If we look at the 12 months to March, in some ways, share price performance was a bit disappointing. Share price total return of 1.8%. But the net asset value total return was 9.5%. So that says to me that shareholders haven't caught on to the fact that the portfolio is firing on all cylinders. And I think that there will be catch-up. And actually, we've seen some of that catch-up since our year end in March, with the share price moving on reasonably positively from March till today. This is the portfolio we acquired just a couple of weeks ago, and it was an interesting transaction for us because this was an all-share transaction, so no cash changed hands. We acquired a family property company that had been trading for about 30 years. They wanted to stay in real estate. 3 brothers that had set up this portfolio. They had 8 children. None of their children wanted to manage the portfolio. So they had a succession issue. They had a looming IHT issue, and to be perfectly frank, they just didn't want to run it anymore. They were all in their 70s. So we have, in a stroke, resolved the succession plan, because we have taken what was an illiquid, lumpy portfolio that was not easy to pass down to the next generation equitably, converted that into liquid shares in Custodian Property Income REIT that they can pass down equitably amongst the next generation. They're no longer running the company, paying corporation tax, paying a manager to run the assets. The manager has actually joined us, so we've retained all that know-how. And in this exercise, the family have also seen an increase in their net income. So a really neat deal for us, because we have seen growth, a really neat deal for the family property company. And we, because we focus on those smaller regional property assets, are one of the few real estate investment trusts that are able to do these sorts of transactions. More on rental growth, but in the interest of time, I'm going to skip on because I've talked about it quite a lot. What do we mean when we say smaller regional property? We're not talking about workshops under the arches. These are modern, fit-for-purpose, commercial real estate assets, and that gives you an idea of the sort of things we're talking about when we're talking about smaller properties. I think in many ways it's an unhelpful term, but we need to make that distinction because these are assets that are all beneath the dignity of institutional investors simply by virtue of lot size, not by virtue of quality of location, quality of tenant, or indeed quality of building. And by fishing in that pond, we are able to deliver a higher income return. And we'll look at that with some data in just a moment. The spread of the portfolio, you can see, very broadly diverse, strong concentration in the northwest, I hope you will notice, because it is a commercial hotspot in the UK. Similarly, you can see in the Midlands, where we have a lot of industrial and logistics property, it is a hotspot for that across the central belt of Scotland. For those of you that know the country well, you'll be able to recognise those commercial hotspots. But we're not in London. We're not in London principally because it is an overly competitive market, which means prices are higher, yields are lower, and therefore the income that we can deliver to shareholders is reduced. And in terms of diversification, what this chart shows is the amount of income that is paid by any one tenant in the portfolio. And there are very few property funds that could put up a chart that is quite as diverse as this. What it means is that no single tenant in any one property is paying more than 1.75% of the total rent roll. And even amongst our largest tenants, there is further diversification. We have 8 properties let to Menzies Distribution, spread across the UK, 4 to Wicks, 4 to B&M Bargains. So you can see further diversification amongst those largest parts of the pie. And diversification is risk mitigation. And we are also able to mitigate risk by having very high quality tenants. I think one of the concerns about our strategy for people that don't understand it is that if we have smaller properties, we have lower quality tenants. Not so, says the Experian credit rating, which you can see in this chart that shows that 84% of our tenants would be considered by Experian lower than average risk. So in summary, what have we got? We've got good quality tenants, broadly diversified in modern properties with rental growth, an entry yield of 7.4% today, and with that rental growth that will deliver capital growth, it feels like an opportune time to invest. I said I'd explain the strategy with the benefit of a chart, and in a minute I'm going to try and do that. So this chart looks at whole market data. It goes back to 2000, and it looks at the net initial yield, or the transaction yield of properties that have traded with a lot size of under 10 million, that's the dark blue line, and over 10 million, that's the light blue line. And you can see that for the first 10 years, there was a pretty narrow and consistent margin of about 65 basis points. So let's call that the risk premium. In truth, probably 50 basis points is the risk premium, and 15 is just the hassle factor that people didn't want to manage large portfolios of smaller properties. So, and it makes the math simpler anyway. So let's call it a 50 basis point risk premium. What have we seen from 2010? That huge divergence. And that divergence was not a comment on risk. It was not because the smaller properties had become higher risk. It's because there were a larger number of actors in the market pursuing relatively large, relatively prime assets, restricted supply, prices go up, yields go down, and it creates, over the longer part of that period, 140 plus basis point margin. Now that's narrowed a bit recently, and I think in the last year it's narrowed to just under 100 basis points, very particularly because of stock selection in the market. There hasn't been a great deal traded, and what has traded, there have been quite a large number of large lot size, high yielding assets like shopping centres and offices that have skewed the numbers. But there's a very comfortable 100 basis point margin, yet the risk premium is only 50 basis points. So we are getting additional margin for taking no additional risk. And that supports both that higher dividend, but it also means that we are better able to operate in a high interest rate environment. We're into the question time now, but I think this is a question you might have asked me. Talk to me about debt. So I'm going to answer it myself. The grey is the weighted average cost of debt, and that is sitting at 3.9% today. The light blue is the initial yield from the portfolio, which is around 6.8, 6.9%, and the dark blue is that reversionary potential, the rental growth that we can deliver on top. And what you can see is there's a very wide margin over our weighted average cost of debt. And in a higher interest rate environment, and I think realistically that's what we need to expect over the next 5 to 10 years, certainly than we've had over the previous 15, then that higher income strategy is better able to cope and continue to deliver returns. All of that has led to us outperforming the FTSE EPRA NAREIT UK index, which is the grey line you can see at the bottom of the chart here. The question is, how have we outperformed? The outperformance has come fundamentally from paying a higher dividend every year. We've all been in the same market. We've all seen the highs and the lows, and market values have gone up and they've gone down, and happily they're going back up again. But each and every year we've paid a higher dividend than the index average. And it's that recurring dividend that has led to outperformance. So I'm going to leave you to read that and take any questions.
Very entertaining. Any questions? That's one at the back. Steve?
Thank you very much. Very straightforward. I'm very convincing as well. But my question to you will be, you invest in all these properties that, they are not kind of household property. They are more like industrial property. What happens with the increase in employer NI and, investors leaving the country as a result of that? What impact does it have on this? Because I think it's going to have that impact on it when people like, small shops leave those buildings because they can't cope anymore and want to close down their business. So how are you going to manage that if that risk suffices at any point in time?
Look, small shops make up a small part of our portfolio, and typically we've retained shops in high street locations that are have a high tourist footfall, typically cathedral city locations, university locations, where there is a large population. And the one thing we know about real estate is that population growth is good for real estate because people need somewhere to live, somewhere to work, and somewhere to shop. And we, despite the non-DOMs leaving and maybe a few others, we've got significant population growth. And I think that's good for real estate. Will the NI have an impact on our tenants? Yes, I'm sure it will. But an awful lot of the buildings that we own, if it's a B&Q, and as you can see one picture there, that's a B&Q in Banbury, they might employ one less person, but they still need the premises. So I don't think that, I can't see a direct read across to commercial real estate, but it's going to have an impact on the edges.
Okay, so are you gonna profile the risk of that? I know, yes, it might be low risk for that to impact on what you're doing, but are you going to profile and mitigate that risk if it does suffice?
I don't think we would go into that detail. If we make buildings attractive to current tenant demand, if they have employment issues, then that's slightly outside. So I mean, there's an issue at the moment with Poundland. So Poundland have put themselves into company voluntary arrangement. They're disclaiming some of their leases. We have 3 properties let to Poundland, 2 are unaffected and 1 is affected. But as a landlord, we will have the opportunity to bring that lease to an end, which we will do.
Okay.
We will bring that lease to an end, kick Poundland out. You don't want to be there, they certainly don't want to pay any rent, and we'll re-let that property. This is one of the great things about real estate. Even if the tenant goes under, you've still got the real estate.
Okay, thank you.
With reference to the slide that's on display just now, how are you going to balance your portfolio? Or where are you going to increase or decrease your weightings? Because both the office and retail markets are considered to be difficult areas. I just wanted to know your views on where you're going to invest.
We don't expect to fundamentally change the weightings. They've been pretty consistent for some time now. But it's interesting, just to pick up on the comment you made, that the office and retail markets are considered to be more challenging. They are probably the areas of the market with the greatest opportunity, if you're brave enough, but it is all about stock selection. So I've given the example of the building in Fountain Street, which is only a short walk from here. We've got another building on Chorlton Street in Manchester, which is an office building we've refurbished. In that building, we took the rents from £18, £19 a square foot. We've let the entire building for £27 a square foot following a refurbishment. And in Fountain Street, the rents have gone from £20 to £36 a square foot following a refurbishment. So there's real opportunity, but it's about creating the assets that tenants want to occupy. And that's our job. It's to constantly rake through the portfolio, which is something we do on a quarterly basis, looking at those properties that either no longer fit what tenants want, and then we have to ask ourselves the question, well, can we spend some money that we will recover in full and some to bring those back into useful use, or are they assets that we need to sell? And actually in the retail market, the out-of-town retail market is what we call retail warehousing, which is the larger part of our portfolio, 22% of the portfolio. They've proved incredibly resilient and really strong rental growth there. Occupiers want to be on retail parks because we as consumers like to park for free, drive to the retail parks rather than battling with the town centres. And the sort of retailers that operate on those retail parks, and in fact, there's another local asset here, that's a B&M Bargains in Ashton-under-Lyne, which is on the east side of the city. There's no competition for B&M Bargains online. You go to B&M Bargains, you don't click and collect from B&M Bargains. But if you wanted to click and collect from a store like Next, then Next were one of the market leaders to move off the high street and onto retail parks. So it's all about the sort of micro location of the buildings to manage the challenge that you've sensibly identified.
Okay, thank you.
Yeah, just given the level of discount that you referred to earlier on against NAV, do you see there'll be much more consolidation in the sector?
Well, there has been plenty of consolidation in the sector. Will there be more? I think unless we see ratings improve, then the opportunity will be there for more consolidation. So I certainly wouldn't rule it out. But we have seen those discounts narrow over the last couple of months.
One here. Steve. Oh.
Sorry.
Wait for the microphone.
Oh.
Thanks.
Last question. I don't think I managed to just hold it close to your mouth like that.
Hold it. That's it.
Okay. Okay, thanks. You've suffered like a lot of companies in your area. The share price has gone down quite dramatically. What appears to be happening, though, we're looking at your chart, your price charts. The market has not yet kind of seen how your company is going to recover. There's very little price movement from the bottom, so to speak. In fact, there's no movement at all. So I was wondering what strategies you have for kind of convincing the market that you have something special to offer in your sector.
Well, I'm here to try and do that to an important subset of the market. And actually, there has been quite a bit of movement from the bottom. You know, the bottom, our share price was under 70p. It was 80p today, and it was 85p last week. So it is now oscillating around 80 to 85p rather than 70 to 75p. So that's a fairly significant uptick. I know we've got a way to go. We're still trading at a discount to net asset value. I think there's just been too much noise and people have overlooked the opportunity. And like I said, we don't need a great deal of additional demand to come back into the market to see share prices re-rate very quickly. You know, the movement in our share price from mid-70s to mid-80s was probably only a couple of million of share price demand. It doesn't take much to change the balance between supply and demand. So,
in your annual report, you were kind of suggesting that you could kind of do more consolidating of the market in terms of going into family-run companies.
Well, and there's one example that I showed you here, the Merlin portfolio. Right. We are constantly combing the market, looking for other opportunities.
You're doing more of that, yes.
We'd definitely like to do more of that.
Okay, thanks.
Thank you very much. That's the end of the questions. Thank you, Richard.